Individual firms often work to obtain an objective. Now those objectives might be something like expansion. They're trying to expand their firm. Or it might be something along the lines of risk reduction. Well, under the perfectly competitive market, we assume that all of the firm's ultimate objective is to maximize economic profit. So what is economic profit? Economic profit is basically the revenue or all of the cash receipts, all of the money that's coming into the firm, minus the costs that are paid and are not paid, or paid in cash and not paid in cash. What accounting profit is something a little bit different. Accounting profit is the profit of the revenue minus the cost paid in cash. So if you get into accounting, or whenever you take accounting, or you're looking at the typical way to measure profit, and that is revenues minus all paid costs. Those are considered accounting profits. But we also have a distinguishing profit in economics. We call it economic profit. And that is the revenue minus all costs, whether they're paid or not. And what I mean by a non-paid cost is something such as land or labor that you already own and you don't really pay yourself for. So, economic profit includes the inputs that are not paid in cash. This includes stuff like land, labor, equipment. So, we estimate these costs using opportunity cost. So let's kind of take a look at an example real quick. We have 3 different farms here. And these farms are actually listed in your notes in a little bit more detail, but this is just a quick sketch. So we have Farm A, Farm B, and Farm B that accounts for economic costs. So Farm A, both Farm A and Farm B both earn $60,000 in revenue. Both Farm A and Farm B have $30,000 in operating costs. Now Farm A has to pay a land rent of $12,000, whereas Farm B does not pay land rent. They already own their land, so they pay no rent. So at the end of the day, the accounting profit for Farm A is $18,000 because it would be the revenue minus the operating expenses minus the land rent. So they come up with a revenue of $18,000. Well, let's look at Farm B. Farm B has a revenue of $60,000, operating expense of $30,000, does not pay anything for rent. So their accounting profit is $30,000. Well, they may look more profitable. We must take into account, what if they weren't farming on that land? What if they were doing something else with that land? What is the cost of them using their own land? Well, the cost of them using their own land can be measured through estimating opportunity cost. If we remember, opportunity cost is the foregone income by using a resource in its current employment. So by using that land in its current employment, we are just farming on that land. But what if we were doing something else? What if we were renting out that land to somebody else? Well, let's assume that they could rent this land out to somebody else for $15,000. That $15,000 is the foregone income by not leasing that land. That is money lost by them not leasing that land. So let's look at it with that $15,000 in place for Farm B. Farm B, they now have $60,000 in revenue, $30,000 in operating expenses, and if they weren't farming on their land, they could be earning a revenue of $15,000 by leasing that out. So that is essentially a cost to the business. If they were to pay themselves for renting that land, it would cost them $15,000. So we account for that land rent in there, or that estimated opportunity cost of that income that they're giving up by not leasing out their land. We wind up showing that an economic profit of Farm B is only $15,000. So let's look at Farm B under the accounting profit. They made $30,000. Under Farm B with the economic profit, they only earned $15,000. And the reason that they only earned $15,000, the reason for this discrepancy in here, is we are accounting the underlying cost, or the cost of that land. Now, since nobody's technically paying for that land in cash, that just kind of goes away. So what it allows us to do is it allows us to estimate those costs that are not necessarily paid in cash using this opportunity cost. We often find this in land, labor, or equipment. Another great example of this would be, what if we had a manager on a farm? Well, what if we didn't farm our own land, but we had a manager? We paid that manager $60,000. But instead of having a manager, we're farming it ourselves. Shouldn't we be compensated for our labor? Well, if we were, we would take the estimated opportunity cost, which would be about $60,000 in this example, and we see that we can now compare apples to apples. Before, whenever we were comparing accounting profit between Farm A and Farm B, we see that Farm B is a lot further ahead. They're making more in accounting profit. But if we compare these two and we add in all the factors such as what land would cost them if they were having to rent it, then we see that actually Farm A is operating more efficiently, more economically than Farm B is. Even though Farm A is earning more of an accounting profit, or Farm B is earning a higher accounting profit, we see that Farm B would actually be less efficient, less economical whenever we account for those costs that are not paid in cash, those economic costs, and we account for that economic profit.